The last three definitions will change how you invest forever. Hey, it's easy to invest $250 a month. All you gotta do is, instead of having a car payment of $500, get a car payment for $250, invest the other $250, 20% over 35 years will definitely be over $11 million if you use compound interest. Screenshot, reread this, keep it on your own. Let's start this journey of building wealth together. I'm not a financial advisor, but I do have disciplined diamond hands. Today I'm going to help you become smarter than 99% of beginner investors by going over 15 terms and explaining how to use them in a practical way to actually profit off of it. Investing pros, man, builds wealth passively, no cap on salary, and will fund your whole lineage lifestyle. Capital gain. What is capital gain? Buy low, sell high. The difference is your profit. If your profit is $50, your capital gain is $50. Float. Float is how many shares are actually available for you and other regular investors to trade. If the float is low, little buying or selling can move the price a lot. The spread is the difference between what buyers are willing to pay and what sellers are willing to accept. If the spread is tiny, you can get in and out easily. If the spread is wide, you gotta pay extra just to enter the trade. If the spread is wide, there's going to be low liquidity most of the times. That's what that means. What is a limit order? A limit order lets you choose your price. You tell the broker, only buy if it drops to this price, or only sell if it hits this price. So you're not just chasing whatever the market gives you. Honestly, me, I've been focused on being a lot more patient. I'm a patient investor. Most of my orders are limit orders. Hey, I want to buy below $100, or I want to sell at a minimum of 105. So I'm always setting limit orders. Volume. Volume is how many shares are traded in a certain time period. When volume is high, there are a lot of buyers and sellers, so your orders will fill faster and you're not stuck hoping someone takes your trade. If you're playing something with low volume, it has low liquidity. The higher volume, the more liquid it is. Blue chip stocks. Blue chip stocks are big, well-known companies that have survived recessions, bad news, and a drought. You buy them because they might not move the fastest, but they tend to be more stable over the long term. UPS is one of my biggest blue chip stocks right now. Growth stocks. Growth stocks are companies that are expected to grow sales and profits faster than the overall market. You're not buying them for what they are today. You're buying them because you believe they have future earnings, which will be much higher. My favorite growth stock would be WRD right now. And they're entering new markets and unlocking new things right now that nobody has ever done before. Value stocks. Value stocks are companies that look underpriced compared to what they're really worth. The market might be sleeping on them right now, so investors buy them expecting for the price to eventually catch up on true value. Index fund. An index fund lets you buy a whole basket of companies in one move. Instead of guessing one perfect stock, you're owning a piece of the whole market. So one loser doesn't destroy your entire portfolio. Like the S&P 500 index, if you invest into that index, you're holding the top 500 public companies in the US. So if you're investing in an index fund, you ain't gotta choose a stock. They're gonna kick out the unprofitable and trash companies themselves, so you ain't gotta pick and choose a stock. You know you're investing in a safe index. Short selling. Short selling is when you bet a stock will go down instead of up. You borrow shares, sell them now, and if price fall, you buy them back cheaper to profit. But if the price keeps going up instead, your losses can stack fast. CAGR tells you the smooth average growth per year of an investment over time. The market jumps up and down every year, but CAGR stays. If this grew at a steady rate, this is the percentage it would be. So you might see CAGR for the SPY as 10%. That's what you'll normally see. ROI, return on investment, is how much you made compared to what you put in. If you invested $100 and turned it into $130, that's 30%. That's your ROI. Bear market. A bear market is when prices are dropping usually 20% or more and everyone is scared. Most people panic and sell. But long-term investors see it as a clearance sale on quality assets. A bull market is when prices has risen 20% or more and confidence is high. That's when everyone claims they're a genius. But the smart move is to remember crashes always come later. Therefore, keep your discipline. Compound interest is earning interest on both your original principal and accumulated interest over time on an investment. When your money earns money, it's compounding growth.